Learning outcomes. After studying this module, you shall be able to 1. Know the various aspects of international taxation, know about the various aspects of tax havens, know about double taxation relief. Introduction. The international interaction of taxation system has been actually recognized since World War I, which plays a significant role in international finance, trading and investment. At the beginning, the international business tax has been derived from custom duties when the goods and services imported from abroad, that is through indirect ways. The international business taxation system has been increasingly liberalized and become an important feature of international system, which stimulated the growth of international investment after the Second World War. The means of international business taxation have been changed with the related increasing in the direct source. The whole taxation system were developed around how business profits are being taxed. International taxation. A tax is a compulsory unrequited payment to general government. This is from OECD 1996. Taxes are unrequited in the sense that benefits provided by the government to taxpayers are not normally in proportion to their payment. As defined by James and Nobes in 1997, a tax is a compulsory levy made by public authorities for which nothing is received directly in return. International tax is best regarded as the body of legal provisions of different countries that covers the tax aspects of cross-border transaction. It is concerned with direct taxes and indirect taxes. This is what Kevin Holmes has said. From an international perspective, taxation would arise when there are cross-border transactions or transactions between two or more persons in two or more tax jurisdictions, or transaction involving a person in one tax jurisdiction with property or income flows in another tax jurisdiction. Why is there a need for international taxation? Globalization has led to greater integration and interdependence of global economies. In recent years, process of globalization has brought nations closer together and apparently increased the international mobility of corporate activity. Thus, it has resulted in erosion of business boundaries. Removal of trade barriers has increased capital flows among countries. The world has become a global village. In such a scenario, earnings of a person is not restricted to national boundaries, and there are opportunities to make money internationally. Thus, there is need for international taxation to define taxation rights among the nations and to avoid double taxation conflicts. Basic principles of international taxation. Two basic principles of international taxation which lays the foundation of many countries' taxation systems are the residence principle and the source principle. Residence principle. Under this, tax liability is calculated on the basis of place of residency of the taxpayer. According to this principle, tax is levied uniformly on the worldwide income of the residents of the country, irrespective of the source of that income, that is, whether it's domestic or foreign. Therefore, it is also known as worldwide system of taxation. For example, UK, US, France, Germany follow this type of taxation. Residence taxation of income is based on the principle that people and firms should contribute towards the public services provided for them by the country where they live. As it is very difficult to determine exact source of income in this highly globalized world, economists tend to favor residence jurisdiction, and it also promotes economic efficiency because the decision where to invest is independent of tax rates. But in reality, pure residence taxation is very naive. The reasons being, no country would give up their right to collect tax from the foreigners doing business within their territory, and also it would reduce the tax revenues of developing countries that rely heavily on source-based taxation. Source principle. According to this principle, the taxpayer is residents of one country, but income is earned in another country. The source rule holds that income is to be taxed in the country in which it originates, irrespective of whether the income accrues to a resident or a non-resident. Therefore, source country taxation is justified by the view that the country which provides the opportunity to generate income or profits should have the right to tax it. This is also known as territorial system of taxation, being used in Hong Kong, Malaysia, and Singapore. Pure source taxation is also an option that has been preferred by some analysts, including academics from developing countries. Tax competition is the major problem that arises from pure source-based taxation, in which the countries compete to attract investors by offering lower tax rate. The situation worsens more when it is difficult to combat abusive transfer pricing under this system and determine the extra source of income. In reality, mixed of both forms, that is, residence and source-based taxation is used. Emergence of tax havens, the availability of greater amounts of mobile capital represents a distinguished opportunity for many countries to attract investors. Taxation has become an important factor in attracting investment. Countries which are eager to attract foreign capital face considerable international pressure to minimize their tax on income earned by foreign investors. Since minimization of taxation of foreign investors has led to budgetary and policy compromises, not all countries want to attract foreign investment this way. The countries known as tax havens offer very low tax rate and other tax attributes to attract foreign investors. Tax havens are the countries which offer themselves to be used as offshore financial centers, have high level of secrecy, good infrastructure. However, there is no universally accepted definition of a tax haven. There are often certain practices that make up a tax haven, and they can, to a certain extent, occur in almost any country in the world. There are roughly 50 major tax havens in the world. All these countries can be seen when we look at Appendix 1. The Organization for Economic Cooperation and Development, which is the OECD, provides key factors to identify tax havens in its 1998 report on harmful tax competition, an emerging global issue. The key factors that are used to identify tax havens are: 1. No or only nominal taxes. No or only nominal taxes on the relevant income is the starting point to classify a jurisdiction as a tax haven, and whether it offers itself or is perceived to offer itself as a place to be used by non-residents to escape tax in their country of residence. Second, lack of effective exchange of information. Tax havens typically have in place laws or administrative practices under which businesses and individuals can benefit from strict secrecy rules and other protections against scrutiny by tax authority, thereby preventing the effective exchange of information on taxpayers benefiting from low tax jurisdiction. Third, lack of transparency. A lack of transparency in the operation of the legislative, legal, or administrative provision is another factor in identifying tax havens. Fifth, no substantial activities. The absence of a requirement that the activity be substantial is important, since it would suggest that a jurisdiction may be attempting to attract investment or transactions that are purely tax-driven. The important aspect to be noted is that the main issues which create so many international concerns are lack of transparency and exchange of information on tax matters. Tax havens and tax competition. The presence of tax havens creates both problems and opportunities for other countries. Tax havens are viewed with alarm in parts of the high tax world. Corporate tax bases in the highly industrial countries are eroded because of increased mobility of goods and services. So tax revenues are declining and competition among governments is increasing. Countries seeking to attract and retain mobile investment and the associated tax revenues may be induced to reduce tax rate. Thus, it can lead to a race to the bottom, driving corporate tax rate below the efficient levels, and under provision of public goods. Tax havens and tax avoidance. Tax havens are used by multinational firms to facilitate avoidance of taxes that would otherwise be owed to the government of other countries. So multinational can reduce or defer their tax liabilities and choice depending upon how government taxes the foreign income of their resident corporation. So it is beneficial to relocate income from high tax where it is being implemented at home country to tax havens under the territorial system used by capital exporting countries, for example Germany, which exempts foreign income from taxation. Under worldwide taxation system that taxes foreign income and provides credit for taxes paid to a foreign government, deferral of income until it is repatriated is more suitable. By delaying repatriations, present value of the tax liability can be reduced. So the multinational firms can structure a variety of transactions, royalty payments, dividend repatriations, intra-firm lending that locate taxable income in low tax jurisdiction and tax deductions in high tax jurisdiction, and transfer price for within firm international transactions with a motive to reduce their total tax obligation. Impact of tax havens on investment. Tax havens attract both foreign direct investment and portfolio investment. Tax haven economies now account for a non-negligible and increasing share of global FDI flows at about 6%. This is according to the World Investment Report of 2013. FDI flows to such offshore tax havens, which are known as offshore financial centers or OFC, have soared, rising from an average of $15 billion in 2000-2006 to $75 billion per year in 2007 and 12. The report said that in tax havens, the vast majority of FDI flows do not go into projects based in the country, instead leads to problem of round tripping. Round tripping refers to routing of investment by a residents of one country through another country, which is the tax haven country, back to one's own country. Thus, tax havens are used as a conduit of investment to avoid taxes. Even more money is channeled through what is known as special purpose entities, which is also called SPEs, set up for facilitating investment or for some specific purposes. Money flowing to SPEs in just 3 countries, Hungary, Luxembourg, and Netherlands, amounted to $600 billion in 2011, dwarfing the $90 billion of flows to tax haven. The various figures which are given, which indicate the value and share of offshore tax havens in global FDI flows between 1990 and 2012. Double taxation. Double taxation most often occurs when both the source country and the country of residence concurrently exercise their taxing right without providing full relief for the other country's tax. Thus, double taxation can be defined in a non-exhaustive way as the imposition of comparable taxes by 2 or more sovereign countries on the same item of income of the same taxable person for the same taxable period. Double taxation of income can occur in 2 ways, judicial and economic. When some income is taxed in 2 states in same period in the hands of the same taxpayer, it is known as jurisdictional double taxation. For example, X company is a resident in country A and operates an affiliate in country B. X company is taxed in country A on its worldwide income, which includes that derived through the foreign affiliate. It is also taxed in country B on the income derived through its affiliate therein. So there is jurisdictional double taxation because one and the same taxpayer, which is X company, is taxed on the same income, that of the affiliate, by 2 states, countries A and B. Double taxation is classified as economic when some income is taxed in the 2 states in some period in the hands of different taxpayers. For example, X company sells good to its parent company Y for say $100, which amount is taxed in X company in its resident country. A and deductible to Y company in country B. So the tax authorities of country A determine that the price is too low and adjust it to $150, while the tax authorities of B refuse to grant Y company a corresponding adjustment, that is an additional deduction of $50. Therefore, the amount of $50 is taxed twice, first as an additional income for X company and then as a non-deductible expense for Y company. Thus, double taxation impairs the economic development of nation. Models of double taxation relief. In order to avoid the situation of double taxation of the same income, various methods have been evolved to solve the problem. They can be unilateral or international. Unilateral measures are concerned with economic policy choices of a particular nation. For example, foreign sourced income of transnational corporation is exempted by many capital exporting countries so that they are not at a competitive disadvantage in a third country market. And in case of capital importing countries, many tax incentives are given to attract FDI. International measures for mitigation of double tax problem include double taxation avoidance agreement, which is also called DTAA between countries, which are also known as double tax treaty. A treaty is not a taxing statute, although it is an agreement about how taxes are to be imposed. There are two types of DTAA. One, bilateral tax treaties, and two, multilateral tax treaties. Bilateral tax treaties is a convention or an agreement between two countries for the avoidance of double taxation of income and capital and bringing uniformity in the allocation of taxation rights in cross-border situation. It is a bargain between two treaty countries regarding the division of tax revenue between them. Strict quid pro quo is not necessary. Terms of treaty depend upon the flow of trade and investment between treaty partners. There are model bilateral double taxation conventions that help to harmonize national approaches to double tax relief and facilitate the negotiation of tax treaties by eliminating the need for elaborate analysis. The two most commonly used model bilateral double taxation conventions are Organization for Economic Cooperation and Development, OECD Model Convention. This was published in 1977 and continuously amended to account for new developments. Under this, primary right of taxation is with the state of residence and operates largely in favor of developed capital exporting countries. It is meant to be used by developed countries in negotiating treaties. United Nations, the UN Model Convention. This was developed in 1980 and meant to be used for negotiating treaty between developed and developing countries. Under this, primary right of tax is with the source state. This is also continuously revised with changing scenario. Multilateral tax treaty is a treaty for avoidance of double taxation entered by a group of nations. They have not gained acceptance for being complex. It is difficult to understand and apply a multilateral treaty than a bilateral one. But multilateral tax treaties can neutralize the potentially distortive effects of differing bilateral agreements. For example, Nordic countries, Denmark, Finland, Iceland, Norway, and Sweden. Relief from double taxation generally follows one of these three methods. Deduction method. Under this method, foreign tax is allowed as deduction from profit liable to tax in the country of residence. That is, foreign tax as deducted from tax base. But this is the least favorable method and used in the absence of tax treaty. Credit method. The home country permits deduction of taxes paid by residents in the host country from the tax on worldwide income due in the home country. Basically, the taxpayer pays the higher of the domestic or foreign taxes. Most countries follow a tax credit mechanism as means of eliminating double taxation. Exemption method. Under this method, foreign income of residence is exempt from taxation in the home country. Thus, taxpayer has borne only the foreign tax on that income. This method is most favorable when tax in source country is lower than residence country tax. Double taxation relief in India. In India, the government has entered into DTAA with other countries. Section 90 of the Income Tax Act provides inter alia that a treaty may be entered into for grant of relief in respect of income which is taxed in both the countries. Exchange of information for the prevention of evasion and avoidance of income tax. Recovery of income tax, section 91 of the Act provides where income accrue or arises in a country with which no DTAA exists. Unilateral tax relief is provided on the doubly taxed income. Summary. In this chapter, we have discussed about international taxation and its basic principles. The presence of tax havens creates both problems and opportunities for other countries. This is majorly used by multinational firms to avoid the tax which they otherwise have to pay to the other country's government. Investment is attracted by the tax havens, that is both foreign direct investment and portfolio investment. Moreover, we have studied about the double taxation as the imposition of comparable taxes by two or more sovereign countries on the same item of income of the same taxable person for the same taxable period. There are model bilateral double taxation conventions that help to harmonize national approaches to double tax relief and facilitate the negotiation of tax treaties by eliminating the need for elaborate analysis.